When it comes to investing, should you aim for the fastest to profit or the deepest discount? In this video, I'll dive through one example with you, Microsoft, on what kind of difference that would make, what are the potential entry points to help you find a discounted stock, and how much time you need to wait in terms of getting the best price versus the fastest to profit. And this will really change your perspective in terms of patience, how long you need to wait when it comes to investing, and what is the potential reward. With that being said, let's get started. We're here on TradingView. This is my chart, and for this study, we actually don't need most of the investing accelerator indicators, so let me just close that. And I will reopen one of them later on when we do a study. But right now we're looking at Microsoft weekly chart from 2020 all the way to today, 2023. And we know that there's a major bear market back in 2022. And during this time, it formed a very long and mature bottom. So if you're investing during this time, it's not necessarily going to be profitable. So the question is, should you try to get the best price possible, which in this case is 220, and versus the fastest price to become profitable, which means higher momentum? Let me just show you a filter. It is a custom indicator I make, which gives you an idea of what the potential turning points would be if you're using some sort of system. So green means good, red means bad, and the white and black colors are potential turning points that's identified by the indicator. So there's more to it than just using a simple indicator when it comes to investing, but it just gives you a good idea and a good starting point for us. So basically what you see here, if you think about this from an abstract level, there's one wave here, second wave, 3, 4, and then the fifth is really the major one. So let me jump over to the whiteboard and visualize this for you. So you have one wave, and then you have another one, and then another one, and then you have a major wave. So that's what Microsoft looks like, and it's very similar to what I have on the notes. So what you have is, based on the indicator, identified 1, 2, 3, 4, 5, 6 turning points, okay? So there's actually 2 turning points here, 3, let me just double check, 4, 5, 6, okay. So there's one more here, 5, 6. So if you're looking for the best price, you'll find that, hey, it's actually almost 210 back October 31st, 2022. So this is really around October. Okay. And then the best price for the fastest profit is around February. Okay. So here. So when it comes to investing, there are like 3 types of investors. There are people who see the drop and they invest really early. The people who try to get the best price, and let's say you do get it based on your system, and then people who try to invest as late as possible. And the end of this bull run currently is at, my screen is blocking it, June or July 2023. So we can just use July as a reference. All right, so what I want to show you is really the number of months you need to wait. Now, when you're looking at this bottom, yes, it is possible for you to even enter earlier, but we'll just group that together with these other people that entered in around June 2022. So if you enter in June 2022, early, it wasn't the lowest low, but you got in at a decent discount. And up till this July point, 2023, you would have to need to wait 12 months. Okay? Now, if you got the best price, which is around 210, October, so November, December, this is 9 months. And then, if you got into the last bottom before the takeoff, which is right here, March. 3 to 4 months. So we'll say 4. So that means when you're investing, let's say you got in at the very last dip before the bull run, you still need to wait 4 months to realize the maximum profit to date. So this is your minimum wait time for max profit. And if you got in at the best price, you need to wait 9 months in total, which 5 out of those 9 months is flat. So you can see it here. If you entered here, you're making some profit, but price is mostly flat before the bull run kicks in. And if you go back a little bit more, you entered early because you're impatient, you need to wait 12 months in order to capture the entire bull run, which only 4 months is the bull run. So that means if you don't know if you're entering in the very last wave, you should have the mental preparation to wait 12 months. So it shouldn't surprise you that, hey, if you enter into a discount stock, which let's say is Microsoft, is fantastic, and you entered early, you still need to wait 12 months. And it shouldn't surprise you because now you have the data to prove to you that, hey, you gotta wait, so it's no big deal. Now, another thing I wanted to do is really the return. Let me bring out the calculator here, and you can see this is what, 260, and then let's say the top is around 340. So I do 340 divided by 260, that's a 30% return if you entered early. So this is 30%. So if you have the return, then you can compare and see what is really the value of entering at the best price, what is the percentage you're giving up versus the wait time. And the second one, let's say you entered at 210, which is the best possible price. 340 divided by 210, that's 62%. And then finally, the least amount of wait time, which is right here. Your price is around 244. So 245 rounded. 38%. Whoop, that was ugly. Let me fix that. So that means when you're looking at the bull run, early, best price, and also late, you get to capture around 30 to 40% of the bull run, which was the average, return if you're buying a discounted stock. And I think that's great. And if you end up wait that extra couple of months, you get in at the absolutely best price, you will get an additional 24% return. Now, having said that, out of this entire period, almost half a year, there's only one day, or you can try to argue it's 3-4 days, that Microsoft dipped below 220. So I use 210, which is actually a very low price. Like, this is absolute low here. So that means the chances of you getting in at that lowest price is not possible. So it's very difficult to do. And if you end up, for some odd reason, get the lowest price, you're probably very lucky that time. So when you look at the annualized return, so let's say you consistently get in late, you capture the bull run, versus you consistently get in at the best price, but you gotta wait longer. In this case, you'll actually find that if you just take the 4 months, you double that, 8 months, you invest in another stocks, you capture that bull run, jump over to Microsoft for another 4 months, this return will be times 2, which will be a 76%, will be higher than the 62%. So from an annualized return perspective, you should focus on stocks that is mature bottom, almost ready to take off as much as possible. Now, there's no way you're going to get this precise point every single time, but then if your investing strategy gears towards this later stage, if you didn't get in 1, 2, 3, at least you try to get in 4, 5, 6, you try to get in a 5 to 6 dip, then you don't need to wait as much and you can turn a profit faster. That is the first option. Now, the second option is, to be honest, 30% with Microsoft in 12 months. That's actually pretty good. So even if you enter early, as long as you enter into a good company at a discounted price, then that's fine. Now, the only problem with this approach is that you don't know where the bottom is, and sometimes during this major bear market, we have seen stocks that never recover. And maybe it's just the lack of other investors' interest, like the mutual funds or hedge funds are no longer interested in it, or it's simply not that great of a company. Now, let me just show you an example. Here we have PayPal. Now, it used to be a great company, and if you look at the growth and all that, it's fantastic. But during this crash, PayPal just went from $300 to right now around $50, $60, and it never recovered. And that's simply the problem. So if you invested as an early investor, which I actually did, I ended up losing money here. If you wait for it, the best price, and if you look at the bottom here, it actually hasn't even appeared yet. The best price is still not appearing yet, so you're still at this in between the stage 1 to stage 2 level. And then you have the third one, which is as late as possible, ready for a takeoff. PayPal is not even there yet. So that means if you invested early, and this is already almost 2 years, you can be waiting up to 2 years and the stock still hasn't come back yet. So that means as an investor, let's say you're investing S&P 500 and you see another opportunity that's better than S&P 500, you must find a bottom that is mature. So you want to get in at this 5 and 6 bottom, which is as late as possible. And I think this is where a lot of the patience come in, because you might be looking at the stock. You're looking at a stock here, right? You're not doing anything. You're looking at a stock here, you're not doing anything. And you're just waiting for this last little part before you enter. Because even if you enter early, the market is not going to go up because you enter, right? And I think that is really one of the key lessons, is that the market doesn't change because you entered into the markets. They're not going against you. It's just that if you entered early, you got to wait because it hasn't gathered enough momentum, enough people, investors, to boost the stock price up. If you can take any insights away from this video, is the amount of time you need to wait to make money when it comes to long-term investing. And I think a lot of people are not ready to wait through the bottom. And sometimes they invest so early that it's going to take years before it comes back. Now, another example, one of my idols, Charlie Munger, and also Warren Buffett. Charlie actually bought a large amount of Alibaba, which I also bought and I lost money on, and he bought relatively early. So before the China market crash and the tech crackdown in China and trying to split Alibaba into 6 companies, Alibaba was a fantastic company with lots of growth in China, and China is rapidly accelerating forward during that time. Afterwards, it went to 200. I think Charlie Munger bought some during that time. I bought some as well. 150, 100. Where does that put Charlie? Charlie actually ends up being one of the early investors. Now, Charlie probably has a very long-term horizon for Alibaba. He believes in the intrinsic value of Alibaba, that it is dominating. It's basically like the Amazon of China. There's a lot of potential. But because of all these other issues surrounding this company, you can argue that the bottom is not formed yet. China is still not fully recovered. It's open, but not really. If you're looking for the best price, it would be October 2022, which is you're right here. We haven't seen the bull run yet. So for Alibaba, you might be somewhere around this 4, 5, 6 range in terms of the number of dips. But you can't really be sure because there's a lot of macroeconomic issues surrounding the company and a lot of uncertainty in terms of whether the government wants to split up the big tech into 6 individual companies. So for Charlie, he obviously got in at a good price, relatively speaking, meaning he got in at 200, average down until maybe his average price is around, let's say, 120, 150. So it's just waiting for Alibaba to come back. But if you follow the principle of getting in late as much as possible and waiting for that momentum, like positive momentum to hit you first, then you don't need to wait as much. If you choose to be the first step, like the early investor for a discounted stock, you can be waiting for years and it might actually not be the final bottom. So instead, with the tools I have in Investing Accelerator, we want to be the last investor to invest, which gives you the least amount of wait time and the fastest amounts of profits by investing in very mature bottom discounted stocks that also have positive momentum. So what do you think? So let me know in the comments.